Welcome to yet another question in our comment section where one of the subscriber is asking us to make a video on comparison between investing in a money market fund and a 1 year or 364-day treasury bill with the discounts from the treasury bill being reinvested in the money market fund. This question is likely to give you the reason why I hardly or don't invite a DIY or a do-it-yourself investor to invest in the treasury bills as opposed to the money market funds. Before we get into the calculations, let's get a few things very clear that make the money market funds outrightly better option for investing other than putting your money directly in the treasury bills. And that would work mostly for those investors who are looking at returns that are above the average return from the 364-day treasury bills, which are the treasury bills that determine the market interest rates. And the first one is the collective bargaining power, the power of having a huge amount of money for investments. It gives you a bargaining power in investing, and that one is only available when you join your colleague investors or other retail investors in the mutual funds. And a good example of a collective investment scheme in the mutual fund category is a money market fund. We do always hold that seldomly small money is attractive in investing. Or rather to say, small money is not attractive in investing. That it does not give you the leverage to bargain for good returns. And for that reason now, when you look at the money market funds, the fund manager will pull resources from many people, build a huge fund or an amount that you will be allocating to different form of investments, attracting advantages or benefits from investing, because in most cases, the higher the amount that you are investing, the higher the rate of return that you get. And a good example is when you look at the previous video when we are comparing our wealth fund and our fixed coupon bond. The second important thing is the average rate of return of the treasury bills. Money market funds, their returns are benchmarked with the treasury bills, with the fund managers promising to give us alpha returns or returns that are a little bit higher than what the average treasury bill is giving us. And that if you look at the list of the top 10 money market funds, they always give you a rate of return that is higher than what you would get if you invest directly into a 1 year treasury bill, which is the bill that is giving you the highest return. If you compare the 91-day treasury bill, the 182-day treasury bill, and the 364-day treasury bill, the 364-day treasury bill, which is the longest bill, gives you a higher return. And that brings us to the third item, and that is the longer the term of your investment or the longer the horizon, the higher the return. The higher the risk, the higher the return, and in most cases, risks match with the duration of investment. Long-term investments give us higher returns, and that is the reason why bonds, which are instruments that we invest in horizons that are of more than a year, will always give us averagely a higher return compared to the short-term investments in treasury bills. That said then, if you compare the treasury bill, the highest horizon in a treasury bill, that is the 364-day treasury bill, and compare with the horizon that is permitted for the fund managers in the money market funds, as per the regulations by Capital Markets Authority, the fund manager is allowed to take up investments of horizons that are longer than the usual period of a 364-day treasury bill, which is limited to 1 year. The fund manager in the money market fund is allowed to invest in horizons of up to 18 months, that is 1.5 years. And for that reason, then, again, the money market fund is poised to give you a higher return compared with the returns from the average 364-day treasury bill. The fourth item, advantage on taxes. In at times when the money market fund manager is given a higher horizon of investment through the regulation of more than 1 year, he is able to take up instruments, short-term instruments that give tax advantages, like when they invest in short-term bonds which add 10 years or more than 10 years, that giving an advantage on taxes at 10%, saving a 5%, is opposed to the investment directly to a treasury bill that attracts a 15% tax, withholding tax, without any advantage. Then once we have looked at those factors, in summary, I'm concluding that theoretically, or with that one in mind, then I don't expect a treasury bill, a 364-day treasury bill will give me a return that is higher than what I can get from a money market fund. And it is on the basis of that understanding why in this channel we hardly advocate for do-it-yourself investors go for the treasury bills, unless you have invested in the money market funds or fund managers that are giving way below what averagely you are getting from the treasury bill market. Then that gives you an advantage investing directly in the treasury bills, because you average higher your average returns. Then if you look at the specific calculations using our compounding formula, when we use an amount of 100,000 as the capital that we have available for this investment, it would mean that out of our calculation, we will get an amount of averagely 118,752.88, and that is from the manual calculation. This figure is collaborated or supported by what we are getting when we subject the 100,000 investment into a money market fund that is giving us a 17.2%. Why did we go for the 17.2%? I decided we use the actual return that is prevailing in the market. And in this case, we also relied on the return that we are getting from the Ethica Money Market Fund of 17.2%. On the side of the treasury bills, we have also gone for the actual returns offered by the central bank as per the recent or the most current report on the returns of the treasury bills. And as per this schedule, you'll notice that the 364-day treasury bill is giving a return of 14.4476%. Another thing that is very important when you are doing your calculations, and that is for those who have dared take the trouble to do their own calculations with regard to what we get when we are getting the discounts or the discounted interest from the treasury bill, because treasury bills are always sold at a discount. And what that means is that the actual amount that you pay to CBK for that particular investment is less the interest that you expect at the end of the year. And therefore, if this bill or treasury bill is for that average of 14.4476, then it means we shall pay less that amount of interest. But very important, in the calculation of the actual interest that you take home or you remain with, because we have to compare an equal amount of investment. We have invested 100,000 in the money market fund. We will compare with investing an equal amount, 100,000, in the 364-day treasury bill. So we are looking at what shall remain in our hands. That is what is the interest that we expect to get from the treasury bill. And because it has been left with us, we are supposed to reinvest it in order for us now to get a matching figure that can compare with another investment that has gone for 1 year. And that is the main mistake that most investors do when they buy the treasury bills. If you have gotten into that investment and you are left with the interest at hand, it only means that the amount that you are paid, you will only get your capital. That is the 100,000 at the end of the year. So if you compare with the other person who invested the same amount, 100,000, in the money market fund, at the end of the year, this guy from the money market fund has 118,000. And yourself, you are receiving in your settlement account from CBK 100,000. And that will only happen kama ulipiga ile pesa ya interest from the treasury bill, ulipiga sherehe. You did not reinvest it to compound and to match with what is happening with the investment in the money market fund. So another important thing, when you are getting this interest from the treasury bill, there is this wording that we use, discounted. And discounting is a method or a process of determining the present value of a future expected cash flow. The future expected cash flow here is the interest. From calculation, a simple calculation, and that is the reason we have used a solid amount, the 100,000, we are getting 14.4476 as the return from this treasury bill. And therefore, if you were to invest the 100,000, at the end of the year, we would expect to get an interest of 14,447.6. But now, because the central bank is giving you that amount now at 0.0 of investment, or at the beginning of the investment, you will not be given the 14,000. You will be given a discounted figure. And therefore, now we need to calculate the discount factor. And the discount factor is a formula we get by dividing 1 by the rate plus 1. So if you subject this 14.4476 to a discount factor, you will divide 1 divided by 1.144476. And it will give us a figure of 0.8738. That is a discount factor that you are supposed to multiply with the future interest or the cash flow. That is the 14,447.6 to determine what's supposed to be the figure now. And that is the reason now why you need to compound this amount in order to match the investment in the money market fund. If you fail to compound or reinvest this amount, you cannot realize the 14,000 that you were given. So once you discount, or if you multiply this factor with the future cash flow of the future expected interest of 14,447.6, you are getting 12,624.3128. That is the present value, or the value of 14,447.6 expected in future now. But another problem is that this amount includes the taxman's return. There is a tax element in this amount that we are supposed to do away with, because you are supposed to pay taxes. So once you subject this present value of the interest amount of 12,624 to the withholding tax of 15%, you are going to be left with a figure of 10,730.67. So that is the actual amount that you'll be left with, because when you are investing, you shall pay the discounted amount plus the tax to CBK. So we shall now take the 10,730 and transfer it to invest it in the same money market fund where we invested the other 100,000. And that amount alone, the 10,730, once we compound it in the money market fund, we are getting at the end of the year an amount of 12,744. So in total, what you will get from the total investment as per the question by our beloved subscriber in this question is, what is the total amount that you will get from this treasury bill having compounded the discounted interest in the money market fund? we shall be getting the total from the money market fund, compounding of 10,730, which is the discounted interest, plus the 100,000 that you will get at the end of the day from CBK. And that will give us a total of 100,012,744. If you compare that one with the 118,000 that we got from the money market fund, then the money market fund has given us in excess of 6,000, concluding that the money market fund will give us more than investing directly in the treasury bill. You need to note that when the central bank is discounting our investments in the treasury bills, they don't use a discounting factor determined by the rate of return from the treasury bill itself. They use a discount factor determined using the current rate at which they are lending commercial banks. And as per October 2024, because we have decided to use the actual figures for relating to this month, the discount factor that CBK was using, it was using a 15% factor, because it is at 15% that they are lending commercial banks. And therefore, their discounting factor is lower than our discounting factor. And therefore, if you are to compare this outcome after calculating using the CBK treasury bill calculator, you realize our actual figure and the CBK calculator figure, there is a disparity of around 26 shillings or 30 shillings that is brought about by that difference, because our discount factor relied on the rate of return of the 364-day treasury bill. So as a conclusion, investing in the money market funds, especially the top 10 money market funds, will always yield you higher returns compared to what you will get from the treasury bill market. That was a very good question, and it has brought about the reason why in this channel we hardly tell you to go straight to the treasury bill market. Thank you for watching, and thank you for that question.